let's get started here. I always like to start off with prayer because if it wasn't for the Lord, we wouldn't be here. So we'll say a quick prayer. Dear Lord, thank you for your love. Thank you for your blessings. Thank you for being in our lives. Thank you for allowing us to be here. May you bless everybody on the call. May this information help individuals and their families. In Jesus' name we pray. Amen. Well, all right. So we're going to talk about the tax code and how we can do what the wealthy does and find some tax codes. Because from a tax code standpoint, most people work for their money. The tax code rewards those who build resources. And the more resources that we have, the more that we can write off. So it's one thing to make the money. It's another thing to use the money that we make to our advantage from a tax standpoint. And we'll talk about that. So the first thing, tax hack number one. All right. So how to get $2,000 tax credit for a college student. Now, if we don't have any students in college, if we have grandkids, then definitely you want to talk to your kids about this because this is something that most people don't do. As I talk to clients, kind of ask them, are they doing this for their children? I would say 95% are not. So this is free money that the IRS gives us that we're not taking advantage of through the American Opportunity Tax Credit or the Lifelong Learning Credit as well, which we'll talk about. So a credit that many parents and students miss out. So we're going to break this down step by step. So first off, what is the 1098 tax credit? So it's Form 1098. Now, this form is provided to you by the college or university that your child or grandchild or niece and nephew, they go to. Just like we have a 1099, right, for many financial institutions. Pretty sure we guys been flooded with 1099s from credit card companies. If you have a credit card from your financial institution, if we have a bank from our investment firm like us, for instance, you get your 1099s. Now, it's different schedules with 1099s as well. I'm kind of going off on a tangent, but from an informational standpoint, 1099 from a retirement account by law that has to be given to you by the end of January. Retirement, but non-retirement 1099s like an investment account, or if you have like a real estate trust and they paid you dividends or credit cards, they have up until March 15th. So a lot of people aren't getting their whole 1099s right now. If they have a retirement plan, they got their 1099, but if they have some type of financial account, they may have not received their 1099s. So it's best for a person really not to, in my opinion, not to file their taxes until, late March, April. You can always get an extension if it's past April 15th, of course, you can get an extension. Because from an IRS standpoint, they care if you owe, but they really care if you don't file. So you get in more trouble with the IRS by not filing than owing. So people who haven't filed in 2, 3, 4 years, they're going to get slapped a bigger penalty and more interest, which is up to 30%, by the way. Up to 30%. So for every $100 you owe, the IRS can penalize and tax you up to $30. Like, that's crazy how much money that is. But even if you owe money, it's always best to file and then kind of defer those payments. I know I went off on a tangent, but for here, the 1098T form is the tuition form that you get from the college. Again, my moderators, as people pop in, that we let them in. It reports tuition paid, scholarships, and grants received. So I'm getting the scholarships, grants, any tuition, they report that. So anything that's done from a monetary standpoint is reported to the IRS. The IRS knows, right? Sometimes we don't have to pay taxes on things, but we still receive a 1099. And the form is needed to claim either your AOTC, which is the American Opportunity Tax Credit, or the Lifetime Learning Credit, which is the LLC. And why it matters, because if you don't have this form, you can't make the claim. So you have to make sure you get this form. If you don't get it for a reason, call the college. By law, they have to send it to you by either mail or email. So they have to send it to you guys. But you want to make sure the first step is getting this form, because you can get up to $2,000 back in taxes. And you're not doing anything. It's money that's already spent. It's just a way for the government to give you some assistance when it comes to being in what are the two programs, right? We have the AOTC, the American Opportunity Tax Credit, and the LLC, which is the Lifetime Learning Credit. Not a limited liability corporation. That's a different LLC. right? So what is the ALCs? ALC, it gives you 100% of the first 2,000 eligible expenses, right? So when something is eligible from an expense standpoint, it could be tuition, it could be room and board, it could be books. But guess what? Now we are in a digital age, and a lot of colleges are now moving some of their curriculum all online. So if we have a child in college and we want to buy them a laptop, well, now a laptop is a eligible expense, because from a tax standpoint, and I always reference this tax code 162A, right? Anything from a write-off standpoint or from an income standpoint has to be reasonable, necessary, and ordinary. Where everybody has laptops now. And the IRS, they do not have a master list of what you can write off, what you can't write off, and what is acceptable, right? It's all just kind of theory. It would be so much easier if they gave us a list of what you can and can't do. But no, they don't give you a list, right? You can do something. If they deem you can't be done, they'll tell you about it later, but it's no master list. But for anybody that has a child in school, a laptop can be an eligible expense. So that's the first 100%, $2,000. Then an additional 25% of the next $1,000, which is basically $500. So that's basically $2,500 of free money that the IRS gives us because we have a child in college that are using money towards either tuition, room and board, meal plan, books. It's free money. And people, for whatever reason, don't take advantage of the free money. And another cool thing, so you have two different tax. You have a tax deduction and you have a tax credit. So a tax deduction is like when we put money into our 401k or a HSA account or a traditional IRA, where it reduces how much you tax. So if I make $50,000 and I put $10,000 into my 401k, from a tax standpoint, I'm not taxed on 1,000, I'm taxed on 40,000. It's a deduction. I get to deduct my taxable income. Well, a tax credit is actually money that they give you. So if you owe money of, let's say, $4,000 and you get a $2,000 tax credit, now you only owe $2,000. So it's actually money that they're giving you, right? So there's a difference between a tax deduction and a tax credit. Most people get tax deductions, but it is things from a tax credit standpoint. This is one of them. If you have solar power, that's a tax credit where they're giving you money. Tax credit. And 40% is refundable, meaning that you can get up to $1,000 even if you don't owe any taxes. Because from a tax credit standpoint, if you get a refund, they don't give you more money. So if I get a $5,000 refund and I get a $2,000 tax credit, most of the time, it doesn't mean I get $7,000. It means I kind of lose that credit. But here, since it's tied to education, the IRS says 40% of it is refundable even if you get a credit. So even if you get a refund, not a credit. Even if you get a refund, they are still going to give you an additional $1,000. So again, it's the way for the IRS to give you money because your children or grandchildren or niece and nephew has higher education. So that's the ALTC. Then we have the life learning credit, right? And again, the ALTC, that's for individuals that are in undergrad. And the LLC is for individuals that are graduate level, right? So graduate level. So 20% of the first $10,000 is qualified expenses, right? So for every $10,000, then I get a credit of $2,000. The max credit is $2,000 per tax return, not per student. So if you have 2 students, right, each student does not get $2,000, unfortunately. If we have 2 students, then each student in that case would get $1,000. So they don't let us, get all the money per se, but yeah, it's not per student, it's per tax return, right? So if our child is, in master's or graduate and they're filing a tax themselves, well, then it's them, right? The parents don't have to worry about it at that point. And it's non-refundable, meaning it only offsets taxes owed. So unlike the ALTC, where even if I get a refund, they're going to give me the money, with the LLC or the lifetime learning credit, if I don't owe anything and I get a refund, then I don't get that extra money. So unfortunately, No extra money with the LLC, right? So who qualifies for it? ATC and the LLC. Again, this is free money, and most individuals don't take advantage of this. Definitely take note. So for the ALTC, you can be part-time or full-time. So part-time is 12 credit hours. Full-time is 13 credit hours or more. So it doesn't matter if you're a part-time student or a full-time student. If it's and I have not done my 4 years, so again, for more undergraduates than the ALTC. Now, this is only for college. I got this question once because a lot of people don't know about this. But if we're in private school, we're paying tuition and it's not college, it does not apply. So it's not like a 529 or a deal where it does cover you private school. It's only for individuals in college, not for private school that's not in college. So yeah, but it has to be a 4-year school where I haven't completed my 4 years. That's ALTC. And again, we have tuition, books, supplies, laptops, anything that helps from an educational standpoint. And as I said before, Rule 162 tax code is no list of what is or what isn't, right? So if your child is actually using their laptop for school, that is an expense. So there we go. And then the MAGI, this is your modified adjusted gross income. So we have our gross income, what we make, then our MAGI after deductions, credits, things of that nature, our MAGI modified adjusted gross income. So if I'm single and I make $90,000 or less, then I qualify for this, right? So I qualify for it if I'm single, making $90,000 less. If I'm married, making $180,000 or less, I qualify for it. So basically, from an income standpoint, about 92% of individuals make $90,000 less single, $180,000 less married. So most individuals qualify for this. So that is that. So step by step. So we're going to kind of give you guys step by step what to actually do. So we know what the AOTC is and what the LLC is, and kind of step by step what to do to make sure that we get this done. Number one, check for your eligibility, right? Because we don't want to go through the process of getting the forms, filling them out, getting our receipts, and then we make too much money, right? So first, we just want to be eligible from an income standpoint. So we want to check eligibility. Number two, you want to get the 1098-T form. So very important, even if you fill out the form 8863 from the IRS to get it, if you don't have that supporting documentation, which is your form 1098 from the college, it doesn't matter. It doesn't matter. So you want to make sure if you have a child or a grandchild or a nephew, whoever the case may be, and you're helping them as a mentor, whatever the case, just tell everybody, because most people do not take advantage of this. I don't know why, but they don't. They don't know. That's why we're here to implore and empower you guys, right? But you want to make sure you get the form 1098 from the college or university that they go to. And then you want to gather all the educational expenses, right? So, of course, most times people pay things either via check, pay it via check, and of course it's on your ledger and your statement, or they pay it on card. I recommend everybody, as I said this, thinking a few months ago, and we can have a side conversation on why. But I recommend everybody, except for your mortgage, because you cannot put your mortgage on your credit card. I recommend everybody do everything on their credit card, and on a week-to-week basis, pay it off with their debit card or the checking account tied to their debit card. The reason why, because anytime we put stuff on the credit card, it builds our credit. We pay it off before the statement date. It builds our credit even more, so we're helping our FICO score. We get points, we get money back that we don't get with debit cards. So I would say, just in general, all expenses put on your credit card and then pay it off week by week. So if we have all those expenses already on our credit card statement, it's there, right? So we don't have to rummage through receipts at the end of the year, which you guys are probably doing now. If you're trying to get write-offs, talk to your tax preparer or your CPA, but it's there on ledger with your credit card, and you had that. And then, of course, when you file your taxes, you need your CPA or your accountant to file the form 8863. So that is the form that you file with your receipt that, you had educational expenses, and form 1098 showing that you do have a child in college and they pay tuition. So those are the three things that we need to do to submit, give to our CPA or our tax preparer. Those are the three things. We do those three things, then we'll get basically up to $2,500 of free money from a tax standpoint. So we stop it here because we might have some questions. If you guys have questions, you can put into the chat or you guys can ask questions. Again, it doesn't have to be about the tax credit. It just be about just kind of not investments, but tax in general or investments if you want to. But just questions there when it comes to the AOTC or the learning lifetime credits that we talked about from a tax standpoint. Any questions?
Yes, the learning lifetime credit. You said for graduate students, right?
Yes, that is for graduate students. Yes, that is for people that are no more in a 4-year college.
Do they get the 4 years too? Or
Yeah. You can use it every single year. So if you're getting your master's or your doctorate, you can use it every single year.
okay.
Yep. Yeah. It does not stop. It does not stop as long as you have your 1098, which kind of shows those qualified expenses. I'm paying tuition. Again, out of $10,000, we get the write off with the LLC. Out of $10,000, we can do 20%, which is basically $2,000. So that's up $2,000 a year. But to get the money, though, we have to not be getting a refund. So if I get a refund of $1,000, then I can't use it. I have to owe Uncle Sam. So if I owe Uncle Sam, let's say $5,000, I get that $2,000 from a credit standpoint. Now I only owe Uncle Sam $3,000 for that year, not $5,000. But that's still $2,000 that stays in my pocket. So when people look at taxes, they look at it as like a savings, but it's actually money that stays in your pockets. So when you save money on taxes, you're actually making money. If that means you don't have to pay an extra $2,000, and I got $5,000 in my bank account, I still have $5,000 in my bank account compared to having $2,000 less that had to pay Uncle Sam. So when we think of tax savings, I look at it as you making money. So if we're able to save $2,000-$4,000 a year over 10 years, that's $40,000 that stays in your pocket. It's a lot of money you can use. So yeah. What other questions do we have? Now I want all you guys to put a 1 because we want some confirmation. So I want everybody to put a 1 in the chat if you guys are going to use this for your children or you're going to tell a friend about this to save them $2,000. There's one thing to get information. It's another thing to actually use it. So let's put a 1 in the chat to confirm we're either going to use this for ourselves or we are going to tell a friend or family member so that they can save $2,000. And you're not doing anything but just, filling out a few papers or having your tax person fill out some papers. So there we go. There go those ones. Positive affirmation. Positive affirmation. All right. So that is that. Right. So then you have additional questions, let me know. But tax hack number 2. So number 2. All right. So this is for anybody with rental property. And it's a tax savings. And it's also protection. I can tell a story. All right. So I love telling stories, the storyteller. So this happened, this was 2019. If we think about, I would say pre-COVID, right? We said like, AD and BC before Christ and then AD BC, right? But before COVID, because after COVID, it's like life has changed. And can you guys think like really COVID was basically 5 years ago? This is a 5-year anniversary, right? We had I think the lockdown started in March or April. But it's been 5 years. The press conference, the president talked about, putting bleach in your system to cure COVID. And I remember watching, I think it was like Entertainment Tonight or Good Morning America. Like they had a thing where like, when you go to the house, go to your garage, take off all your clothes. You can't spread COVID into your house. It'll kill everybody. It's like we did not know. Like we still don't know everything about COVID, but it's just crazy. COVID was 5 years ago. It seems like a lifetime. Anyways, though, I digress. So in 2019, unfortunately, I had a client, he had property in Georgia, and he had people that was renting his property. They had a Doberman Pinscher. So if you guys know anything about Doberman Pinschers, they're beautiful dogs. They are aggressive with a capital A, just very, very aggressive. So unfortunately, now he didn't know that they had a dog, but it is what it is. So as we let more people in, my mind, if y'all can let some more people in, as people are popping in, rather late than never. But yeah, so my mind, so you can let people in. So yeah, so they had a Doberman Pinscher. So with the Doberman Pinscher, unfortunately, he bit a person who worked for FedEx, bit the ankle and actually tore a ligament in their ankle. So the person did not work for like 6 months. Well, guess what the person did? I'm not saying it's not justified. He's just delivering a package, but he actually sued. Well, he sued the people that was renting, and also he sued the homeowner. Well, the homeowner did not have a LLC. So sued for lost wages, sued for surgeries and things. It could have like $110,000, right? And the person had insurance, just insurance, but guess what? The renter's insurance didn't cover. It didn't cover dog because he did not know the renters had a dog. So guess who was on the hook for about $80,000 of that money? The homeowner. And the homeowner did not have his assets in the LLC. His rental property in Georgia, his rental property in, I think it's Wisconsin, or maybe in Iowa. Either or though. But yeah, but so those rental properties, and so nothing was protected. So basically he had, in order to pay them, he had to take equity out of, because he wasn't selling his investments because it was tied into his Ks. He didn't have any money with us, was helping manage his 401k. So in order to pay that off, he had to take money out from an equity standpoint, like do a line of credit in the HELOC to pay for that lawsuit because he did not have his assets protected. So if he would have had that LLC, then if they would have sued him, they could only went after him. Well, from a suit standpoint, they can't go after your 401k or your traditional IRA. So if he had his money protected in the LLC, it's unfortunate, but he would have had to, it wasn't his fault because again, it's not his dog, it's his renter's dog, and his renter's lied to him, but he would not have been on the hook for $80,000. So I say that to say, even from a tax standpoint, which we'll talk about, if you have anything from an asset standpoint, it's always best to put it in an LLC, whether that be rental properties, if you have a business and you have a, car, you want to make sure the car is in the LLC, not in your name, because if you get into an accident, then you have all your stuff at risk from an asset standpoint. So if you have any rental property or any assets, you always want to make sure it's in a LLC. You want to separate it. And again, for our client, it's very unfortunate he didn't know about the dog, or he would have had his own renter's insurance. Again, $80,000 out of his pocket where we had to take out loans against his house to pay something that was not his fault at all. And if he had those LLCs in place, it would have happened. So change it for another day, but definitely make sure every single asset that you have is in the LLC. So it's legal protection. So it shields your personal assets from lawsuits, right? So the things you have personally, it shields it from lawsuits. Now, retirement plans up to $1 million is also shielded. If you have a pension plan, that's shielded. That's why, OJ, after he got sued and all that money was awarded to the Ron Goldman's family, he was still kind of just living his life, right? Because of having everything shielded. But it just shields. But from a tax standpoint, it maximizes your deductions with the clear expense tracking. So if you have LLCs, you actually get to maximize all of the taxes that you have from a deduction standpoint, which we'll talk about. Also, professionalism. LLC adds credibility. So in a competitive market, now right now, it is more renters and owners because of interest rates being high and individuals would rather rent than own. Not saying it's right, not saying it's wrong, but that's kind of where we're at today. It was a study done by Nielsen 3 years ago. If a renter has a choice either to rent from a business, personal person, they would rather rent from a business because they think it's more stability if the renter is a business owner than a personal owner. So if it's a competitive situation, it's good to have your stuff structured in an LLC compared to personal. So that's that. All right. So the two LLCs tax strategies. So what do we do here? So first off, your first LLC should be the property holding company, right? So which is your company. I'm sorry, your house. So if my house is on 123 Main Street, then my LLC should be called by name, let's say Mario Payne, 123 Main Street LLC. So if you have two rental properties, one on Main Street, one on North Street, we should have two LLCs, one for 123 Main Street LLC, and the second one for 123 North street LC, right? Because again, it just kind of gives us added protection. So it holds property in a separate entity protecting your house. Now, since you're the owner of the LLC, you have ownership of it. So it's still yours, but it protects you against your personal. They can only go after that one entity. So again, using that same example with the FedEx person, he got bit, he sues, he can, sue personal, nothing personal, so he can't do anything. So, you just kind of, he would have been screwed. Unfortunately, screwed in that case. But since everything was filed on the personal, he was able to win that judgment. And you collect rental income from the renter. And this is very important, right? So now the LLC is the one that the renter is paying, not you personally. Because from a tax standpoint, if it goes to a business, we get to do what you call a pass-through. We pass through the income from us as a business to us as personal. But since we're able to pass through the income, we get to pass through the expenses as well. When it's personal, you're not able to write off the expenses. When we cut the grass, when we had to do repairs to our rental house, we're not able to write that off. But structured this way, we're able to write that off. So it's money that you're spending already that now you're going to get back on your taxes, which will show for you. And also claims depreciation on the house to reduce taxes. So we can then depreciate, right? Is what you should be doing from a rental standpoint. But since it's a pass-through, it's more deductions that way. That's the first LLC, right? The house. But then the kicker to maximize your deductions is to then do second LLC. The second LLC is a property management company. So you're doing a property management company where you're managing the property for your LLC. It's still your company, right? But this is what you're doing. Pays for maintenance for the house, right? So now when you currently use a property management company, if you do, it's typically 10%. So if you're getting $12,000 a year, you're paying that property management company $1,200, right? Because they're making sure things are going good. But for you, from a write-off standpoint, now all the maintenance that's done is not done out of your pocket. It's done out of your property management company. So now, since you have income coming in for your property management company, you're able to write off the expenses. So if I have a roof leak and it costs $10,000, without having this structure, it's just $10,000 that I don't get back from a tax standpoint. Doing it this way, if the property management company pays to fix that roof, and it's your money, so you're moving money from your personal account to your second LLC to pay for it. So it's not like it's money out the air, it's still your money. But since it came from your second LLC, the property management company, you get to write off that $10,000. That is free money that we get by using the tax code to our advantage. And it pays for all the operations of the house. If you guys are hip hop people, right? It's a famous rapper called Rick Ross. And he famously bought Evander Holyfield's house. Well, he literally hired under his property management company a farmer because he keeps livestock on the property for a write-off, but then lawn care, right? So, and then also a pool. So he basically hired two people to basically do his pool, and he hired people to cut his grass. So by doing that and paying them, basically all of the expenses from a property management company pays itself, kind of offset his property taxes. And it's like the fourth, fifth largest property in the world. I mean, in the U.S., it's big. It's like 50 acres. It's huge. But he basically pays next to nothing from a tax standpoint because of him having this property management company kind of doing all that and then paying himself. Because he's paying himself, right? If I own the property and I pay the property management company, which is my company, I'm paying myself. So it's ways for you to use the tax code to your advantage. So all the operations, second LLC pays for, and then again, you charge a fee, right? Because if you don't charge a fee, then it's not justified. So your LLC that's getting the rental income from the renters is now paying your other LLC, the property management company, a maintenance fee, which all property management companies do anyways. So that's the strategy. Very, very easy, right? And you're doing the same thing you're doing now from a rental standpoint, but you're saving more money. Let's go back, right? So how to set it up? Sorry, you guys. So how to set it up? Number one, we transfer the title. So you have to transfer the title, right? So if you have it's for the first LLC. So if our rental property is in our name, then we just transfer it over the title to our LLC. you're still the owner. So it's still your LLC. You still have complete ownership. It's not like you transfer over to an LLC and somebody else owns it. It's your LLC. You're 100% owner. If you're married, it's you and your spouses. It's yours. It's just that it's an entity instead of a person. So it's more protections and more tax write-offs being an entity than a person, which is crazy. Like the tax code should be different. Like it should be we the people, right? We the people should have more tax write-offs, but businesses get more tax favorability with the IRS than the actual person. So yeah. You want to update the lease. So your lease that you have now with your renter, they're paying you, the person. You just need to update that and have them sign it. So where they pay you, the person, but your business. So again, very easy. You're not doing anything crazy. Just very easy. And then also insurance. You do have to let your insurance company know. Then they're not going to write a new policy, but they just have to change the title of it where the owner is not you as a person. It's your LLC. So very, very easy. Very, very easy. So that's LLC number one. Then after that, we create LLC number two, right? And when we do that, we have to open up a separate management. So you want to have two different accounts from a banking standpoint. We have our business account that is getting the money from our renter to us. That's one business account. And then at the same bank, just a different account number. The second account is our property management company, right? Because we do need to justify two different accounts. You can't have everything in one account. It doesn't work like that. You have to have things separated. So very easy. You go to the bank, just open up a separate account with the second LLC. Very easy. You're not doing anything crazy. You're not moving mountains like the Lord. Very, very easy. Then we sign a management agreement. So your first LLC says, hey, my second LLC, I'm going to be the property manager. So I'm allowing you to manage my property, even though it's mine. But from a law standpoint, you have to have an agreement in place. You can't just have write-offs with no agreements, right? Because you are a business. So from a business standpoint, you have to make a management agreement, but you go online and find one of those for free. So yeah. And then we just want to make sure we track everything because things have to be separate. One LLC getting the money, other LLC paying expenses for our property. So it has to be separate. So you want to use QuickBooks or Wave. Now QuickBooks is a fee. It's about $80 a month. Or you can use Wave, WAVE, like I'm swimming, a wave, right? It's where you basically attach your bank accounts to that and they track everything for you. So you don't have to pay the bookkeeper $250 a month. Nothing against y'all bookkeepers out there. Y'all are needed, but you don't got to pay a bookkeeper. You can literally link your LLC and your property management LLC. It does all the tracking for you. So at the end of the year, you have that, you give to your tax person, and he or she will file it. So very, very, very easy, right? So an example. So example that we did for a client 2 years ago in 2023. I have more examples for 2024, but we're just going to give this example, right? So they had a rental, they actually live here in Jacksonville. They had rental income. They are on the new north side off of Alta. I know like the old north side is, like 32209, but it's like the new north side, 32255 or 25 off of Alta anyway. So, but rental income, $30,000. So it's getting basically $2,500 a month, $30,000 a year. The maintenance cost was $6,000, right? So to kind of maintain, cut the grass, do things, somebody knocks a hole in the wall, I got to get dry water, fix it, about $6,000, right? And then usually most property management companies charge you a 10% fee to basically manage the property. So their property management company they created was charging their own self, their own LLC, right, $3,000. So without the two LLC structure, so if it was just personal, where they did not do the LLCs, or they did an LLC to protect their business, but they didn't do the second LLC from a tax standpoint, they had costs and fees of $6,000. Well, guess what? Since it's personal, they don't get to deduct anything. So it costs $6,000 to help the upkeep of my rental property, right? But I don't get any tax deductions. It's just money that's out my pocket. Now I get the income, but it just comes out my pocket. Nothing I can do about it, right? But with this structure, with the two LLCs that we helped them set up, SunBiz, you just go to sunbiz.org if you're in Florida. Very, very easy. It takes 5 minutes. It's not like it's rocket science. we could definitely help as well, of course, as if I'm your certified financial planner. Not then, you're on your own. But with the two LLC structure, the cost and the fees was actually $9,000, right? Because the cost to kind of run their rental property, cut grass, fix water leaks, things of that nature was $6,000, plus an additional $3,000 because their second LLC, right? They were paying to maintain the property from a management standpoint. So that's $9,000. So guess what? Even though $3,000 is out the same pocket because I'm moving money from one account that's mine to another, but I was able to get another $3,000 from a tax write-off standpoint. So with the same money, I get more tax write-offs. But since it was structured this way, that's $9,000 in tax deductions. A $9,000 tax deduction and a 30% tax bracket, that's if we make $140,000 or more, that is $3,100 of money that comes back to me. So literally doing the same thing that they're doing now, because expenses don't stop at your rental property, right? But the same thing that they did the year before, they got an additional $3,100 back from a tax standpoint. If they did this for 10 years, not including raising their bills, raising the cost of things, because we know things go up, but over 10 years, that's over $31,000 that they get, that they make by doing the same thing they're doing now. So anybody that has a rental property, if you're not doing this, you are throwing away money. And this is how we hear stories about rich never pay taxes. This is how to do it. Anybody and everybody can do it. It's just shuffling paperwork around and making things are structured properly. All right. So common mistakes. So common mistakes that you need to avoid. Long way, right? So common mistakes we need to avoid. Number one, failing to transfer the property title to your LLC. So you can create your LLC, but if you don't do that quick claim deed and transfer from your name to your LLC's name, null and void, right? You do all this stuff, but then your CPA is going to say, well, I look, title doesn't match, can't do it. So all this work you did doesn't work, right? So you want to make sure that you transfer the property from your name to your LLC. Do it anyways to protect yourself. It's like I gave the story about our clients in Georgia with the FedEx worker. Commingling funds, you want to make sure that your personal and your business expenses are separate, right? So personal is one thing, business is different, right? So that's why I say you should really have, in that case, 3 bank accounts, more theoretically. Personal bank account, LLC number 1 bank account that's getting the money from your renters, and then LLC number 2 that's getting the money from your LLC 1 to pay for that maintenance. I'm sorry, the cost to basically maintain or property management the company. So 3 bank accounts, right? And again, use Wave, WAVE, or QuickBooks to just link your stuff. So you don't got to take notes, lick with a pencil and write on paper every single month. Just have it set up. It's done automatically. No written agreement. So the IRS may disallow the deductions. So you need to have a written operating agreement with your renter and your LLC. That's one. You also need a property management agreement from your LLC to your property management LLC. Anybody with rental property now, if you have a property management company, you have to do an agreement saying that, yes, you're going to pay them and what they're going to do. Same thing. You're just doing it for yourself, right? And then also mislabeled expenses. You need to distinguish the maintenance costs that you are paying for the first LLC that you're receiving, and also the cost that you're charging your first LLC with the property management company. So all the expenses should be labeled properly. But as I said, if you have Wave or QuickBooks, it does it for you. So you don't have to worry about collecting receipts, what's labeled what. It does it for you. It's software that does it for you, and Wave is free. I don't get paid to use Wave. Now, I use Wave and QuickBooks, believe it or not. I guess I'm OCD there, rather safe than sorry. In the Bible, the left hand knows what the right hand's doing, right? But yeah, but Wave is free, QuickBooks no more than $100 a month. So yeah. All right, so we'll stop that there. Questions that we have. Okay, Lamisha. So does a trust protect your assets? Yes, great question, Lamisha, or Lashima. If I jacked up your name, my apologies. Beautiful name, by the way. Right, so if you have a trust, what you want to do, you first want to have your property in an LLC. right? To protect yourself. Then to protect your family from a tax and death standpoint, you want to put that LLC in a trust. So you go from personal property to LLC, and then the trust covers the LLC. So you would put the LLC as the property inside of your trust, and it protects it. Also protects it from a tax standpoint as well. Yeah. So from a tax standpoint, if a person passes away and they do a quick claim deed, then they don't get that step up. So let's say I bought a house for $100,000. I quick claim it to my children. It's worth $200,000. They sell it. They got to pay $100,000 in taxes. If I do it through a trust, then it's a step up. So they get the property as if they paid $200,000 for it, not 100. So if they sell it for $205,000, they only pay $5,000 in taxes, not $105,000. So everybody, I recommend to trust anyways and use us, the relaxestate.com, but you definitely want to do a trust just from a tax standpoint to make sure that your family doesn't pay all those taxes from when you bought the property when they sell it standpoint. So great question. Do you have to establish the LLC prior to purchasing the property, or yeah, you can do it whenever. Yeah, you can do it. So great question, Bella. Doesn't matter when you establish the LLC, you just want to make sure it's done, right? So it doesn't have to be when you first buy it, it could be after the fact. So you can do it now. And anybody with rental income, I would strongly recommend you do it now. OLU, can you transfer your home to an LLC when a home is already in the trust? So Ola, so what you want to do is that you want to, so first off, great job doing a trust. Only 21% of Americans have a trust. So great job for you having your trust. But what you want to do, you want to transfer ownership of your property from you into your LLC, right? And then after that, then you want to redo your trust. And if you used us, the relaxestate.com, you can update your trust anytime you want to. And I have to pay a $250 retainer fee, so it's free. So then after you move your rental property into your LLC, then you update your trust. And then you just change the property from your name to the name of your LLC. And then you get it notarized, and then you're good to go. So that's a great question. So Wave and QuickBooks, that's what you want to use. Joining late, you missed a lot. Yeah. So Charlotte, you'll get the links as well. So Monica, if you have two properties, can you use the same property management company? Yes. Great question, Monica. I think you're in California. So you woke up early to hear me? Oh my gosh. I was in Vegas last week. The time difference of 3 hours, you guys, that gets you. I'll be 43 next month. I'm not a young man like I used to, but man, that 3-hour time difference is crazy. Crazy. But yes, so if you have 3 different properties, you should have 3 different LLCs, but then your property management company is only one. So that property management company will manage all 3 properties, right? But that means you have to have an agreement for property number 1, property number 2, and property number 3. So all 3 different properties should have their own agreement with that second LLC. But yes, you only have to have one LLC from a property management standpoint. So that is a great question. Good. All right. So number 3, tax hack number 3. To get more questions, put them in the chat. All right. So retiree tax hack, sell your stocks tax free. So anybody that's retired over 59 and a half, it's a way that you can actually have stocks, mutual funds, or real estate and have the gain tax free. What? We can sell our investments and not pay taxes? Yes, from a capital gains standpoint, which we'll talk about. So you can sell your investments and not pay taxes, and you can use the proceeds to supplement your income, which is always good. So how do we do that? Well, first off, they have to be in a non-retirement account, right? So we get this question a lot. When a person's 72 and a half now, they have RMD, they want to move it over, different things that you can do. But if you do it this way, it's a way for you to have the money invested and grow going forward and not pay taxes. But it has to be a stock or mutual fund in a non-retirement account to qualify for tax break. So if you have an IRA, traditional IRA, then unfortunately, this doesn't apply to you. If you have a Roth IRA, it does apply to you because a Roth IRA grows tax free. And also real estate. So if you have real estate, this also qualifies for this tax break as well. So a stock, a mutual fund, it qualifies. Fortunately, if you have a fixed account, like a fixed annuity, I'm not against annuities, we do annuities, but if you have an annuity, it does not qualify for this tax break. Or if you have a CD, it does not qualify for this. Or if you have a money market, if you was to sell that money market account, you don't get this tax break either. So it's only for stocks, mutual funds, real estate. Oh, I got 10% left. I should be good. I didn't charge the laptop. All right, so that is that. 0% capital gains tax explained. So how do we do it, right? So IRS offers a 10% on long term. Now, long term is when you hold something for 366 days or more. So let's say I buy a stock on February 1st. If I don't sell the stock until February 2nd of the next year, which is 366 days, that is a long-term capital gain. A long-term capital gain in general is either 15%, that's the max, or 0%, which we'll talk about. A short-term capital gain when you sell something that's 365 days or less. So if I buy a stock on February 1st and I sell it on July 1st, that's a short-term capital gain. You're taxed at your tax bracket. So if I'm in a 25% tax bracket, since it's short term, I'm paying taxes on 25%. So if I made $1,000 with that sale, I got to pay Uncle Sam $250. So people who do day trading, right, or swing trading, right, that's less than 365 days. They're getting themselves in trouble because yes, they might make more money, but they're paying far more taxes. That's why long-term investing is always the way to go, because over time you should make money, but then number two, we pay a lot less in taxes. So I have total for a year, but the tax break offers $47,000 or less. So if I'm single and I make $47,000 or less, then I have this tax break. Or if I'm married and I make $94,000 or less as a married couple, then I get this tax break as well. Now, retirees can unlock these tax-free profits on stocks, real estate, and mutual funds because the income limits, which I talked about, they have to hold it for at least 1 year, 366 days. So kind of what we did several times over the class, but there was $60,000. They're couples, so they basically are on Social Security, right? They have Social Security. They have some stocks that was inherited to them actually years ago that we've invested over time. But there's examples. So with the Social Security, because Social Security, even though you don't get a tax form, you still pay tax on your Social Security. I know I talked about this a few weeks ago, how to reduce that tax on Social Security, but in general, we still pay taxes on Social Security. So they sold $15,000 of this stock. That's had Tesla stock. Tesla stock went down like crazy in 21 and 2022, 23. But last year, definitely great recovery. And now Tesla is almost at an all-time high. So if we held it, now we all have our opinions about Elon Musk, good or bad. I have a Tesla, so I'm kind of biased against the car. But yeah, so we bought Tesla, it went back up. So they ended up making money, right? So we sold it $15,000 of their stock. So their total income, that $15,000 was $75,000. Now, income, but they didn't pay income taxes on it. But anytime that you get money, it still counts towards your income. Now, it might not count towards you paying taxes, but it counts towards income. So this is a huge myth. Well, if I have a life insurance policy that's tax-free, I don't pay taxes, it doesn't count towards my income. That's wrong. It counts towards your income, you just don't pay taxes on it. Okay, two different things. Anytime you get income, it goes towards your income. And that's why we have our MAGI, our modified adjusted gross income, and our AGI, our adjusted gross income, right? So that's why we're taxed on our MAGI, our modified adjusted gross income, not our AGI. So yeah, so they don't pay taxes, but it is income. Since $75,000 is below $94,000, this $15,000 was tax-free. So again, using that kind of 15%, all right? So if they would have to pay taxes, 15% on $15,000 is basically $2,200. So by doing it this way, they saved $2,200. That's real money. Now, is it $5, $10, $15, $30,000? No, but I don't know about you guys, but if it's a way for me to save $2,200 or make $2,200 because it doesn't go to Uncle Sam, I'm okay with that. So by just using an easy tax strategy, not doing a CD, not doing anything else, just put it into a stock, letting it go down and back up over time, they save themselves $2,200 of real money. So staying in the 0% capital gains basically allowed them to increase their income. I'm sorry, decrease what they would pay from a tax standpoint, right? So pretty easy, simple there. But what questions do we have for me? You got questions, you can either put them into the chat or you can just unmute yourself. There could be other tax questions as well, but what questions do you guys have for me? No questions? It has to be some questions. And again, it could be other tax questions as well. It doesn't have to be this. And if you want to put it to the chat because you don't want to announce yourself with your tax questions, which I understand, you can definitely put them to the chat. But let us know what question.
I have a question, Maria.
Yes.
Is it a fallacy or is it real that you could use your stock portfolio to purchase real estate without liquidating?
No, that is not a fallacy. That is real love. And side note, but I don't know if you guys are Mary J. Blige fans, but like Lifetime has a 3-part series called Real Love. It's based on her songs. It's a great. And I'm not a Lifetime fan. My wife loves Lifetime, but yeah, we watched that with my mom. It was kind of weird, but whatever. With my mom last week, but yeah. So Real Love, 3-part series, Mary J. Blige, love stories, pretty cool. Anyways, though, yes, it is real. So you can do a loan against your stocks. Now, a couple things. It has to be in a non-retirement account. So if a person has a 401k, you can borrow against your 401k if you're still working. If you're not working, you can't do it anymore. So if I'm working, I have a 401k, I can borrow against it. If I have a traditional IRA, I cannot borrow against my traditional IRA. If I have a Roth IRA, I cannot borrow against my Roth IRA. If I have a 457, I cannot borrow against my 457. If I have a 403b, it depends on the company, right? Now, if I have some regular investment account that have stocks, I can do what you call a collateralized loan, where I can take up to 50%. So if I have $100,000 in stocks, I can borrow, like it's a house, I can borrow up to $50,000 and I can use that for whatever. I can buy real estate. I can do whatever I want with the money, right? Now you're charged interest plus prime rate, which is about 8% right now. So for every $100 that you borrow, your interest is going to be about 8%. Okay. But the good thing about that, no income. So if you go to the bank, they're going to get all your information, right? Unless you do the hard money loan, which I brought Chris on a few months ago. You go that way as well if you want to. But if you go to the bank, you got to verify income. They're going to pull your credit. So not saying you have bad credit, but in general, a person has bad credit, they can't get it. But if you just borrow against your stocks, it doesn't matter if your credit's the best or the worst. Since you're borrowing against your own money, you can get it. Doesn't matter if you're retired making $12,000 a year, or you're a fat cat on Wall Street making $1 million a year. Doesn't matter what your income is, you can still do it because you're borrowing against your own money. So yes, you can do it, but again, it has to be in a non-retirement account, and you can borrow up to 50%, and the interest rate is about 7 to 8% right now. That was a great question, though.
Thank you.
Yeah. So we had another one. What retired tax hack are most teachers that have investing? It's a lot, Denise. HSA. I know I talked about it before. You need to actually hold on because my battery's about to die on my laptop. Let me put on my charger. Hold on 1 second. Give me 15 seconds. Battery's about to die. We'll get rid of the microphone. Yes, that's all. All right, you guys still hear me? Put a 1 in the chat and say yes if you guys can still hear me. I check out my microphone.
Got you.
All right, cool. Also, yeah. So for teachers, a couple things. So teacher has a 4B. Now this is not a blanket recommendation, right? Because everybody's situation is different. So one person who's a teacher might be different. But just in general, if you work for a system that does not match, they're not putting in money. Like if I have a 401k, if I put in 6% of my salary, the company's going to give me 6% free money, right? So I make $100, I put in $6, my company gives me $6. It's free money. With most schools, they do not match. So if you put in $6, they're not going to give you free $6. So I, on the surface, don't recommend that you do a full 3B because you're not getting free money. You get the tax write-off, you're not getting free money. From a tax standpoint, the first thing you want to do, I would say, is do an HSA account. You can do up to $8,000 if you're married, $4,000 if you're single. HSA account, it's a health savings account, right? But it's free money. because if I put in $8,000, it reduces my income from, let's say, 50,000 to 42,000, which means in real money, that's $2,000 I get back. So the IRS is giving me $2,000 by putting money in a health savings account. But with the HSA account, the money grows tax free. So you can put it in money market that makes money, or you can put it in stocks inside your HSA account. It makes money. But all the money grows tax free. So let's say we put $8,000 in for 1 year and we don't put any other money in. You should, but if you don't, let's say 5 years later it's worth $20,000. You take out all $20,000 and not pay any taxes on it. Compared to if it's a 403B, you got to pay taxes. $20,000 in a 403B will be $15,000 after taxes. In the HSA account, $20,000 is all $20,000, as long as it's used for medical expenses. Whereas I say, from a tax code standpoint, it's no list of what a medical expense is. It could be a deductible, it could be a premium, it could be I have high cholesterol and I'm gonna hire a chef to make my meals now, so I don't have to take my high cholesterol medicine. That's a medical expense. It could be a surgery for you or your child, right? It's, hey, I had to have a procedure, have a client who's going to actually use the HSA from their employer to help get lipo. And it was justified because it's a surgery, right? So I'm not saying nobody needs lipo. I'm just giving that example. The IRS does not have this huge document of what you can use for medical expenses and what you can. It has to be ordinary, necessary, and reasonable. And if I have problems and I need to have a surgery that's going to prolong my life, well, that's necessary and reasonable. So I hope that answers the question. After that $8,000, then you do the traditional IRA because you have more flexibility from a tax write-off standpoint, or you can do real estate, which we can talk about separately, where if you do a short-term rental, you get to write off all that, which would actually give you money back. So yeah, that was a long tangent, Denise, but we're here to help. So definitely let us know. Okay, so Bella, I think I missed something on the last hack. The couple were 0% tax bracket. Why the income was less than 60. No. Married, right? So $47,000 single, $1,000 married. So if I'm a married couple and I make less than $94,000, then I get the 0% tax from a capital gains standpoint. So yes, if it was a single person making it, which is great because the average single person in retirement makes $42,000 between Social Security and income, or Social Security by itself $22,000. So great for them. But if a person is single making $60,000 as a retiree, then they cannot use that tax hack. But if they're married making $60,000, since that's less than $94,000, then they qualify for it. So I hope I answered that question. Cool. What other questions do we? These are great questions, you guys. What other questions? We shouldn't miss anything. Wave and QuickBooks, those are the two ones that you want to use. Next month is National Credit Month, so I think we're going to talk about building credit, establishing credit. It's a friend of mine that has a credit repair company that kind of talks about what to do credit standpoint. So we'll talk about kind of how to build credit, how to establish credit. In 2 weeks. Then at the end of the month, we'll have a person kind of talks about how to, if you're on the brink of bankruptcy, kind of the things you need to do not to go bankrupt and things of that nature. So we'll probably talk about credit next month as we find ways to have you guys grow your money. Let me say a prayer to take us out of here. Dear Lord, thank you for your love. Thank you for your blessings. Thank you for being our lives. Pray for this information help individuals, and you continue to bless us. Bless everybody's friends and family members on this call as well. In Jesus' name we pray. Amen. So yes, so we will have another call. We always have it the first and the third week of the month on Wednesday. So Wednesday at 12 o'clock. I don't know what date that is, but the first week of March it'll be there. You will get a recording of this tomorrow. So yeah, any friends and family. So this is my way to kind of give information, right? So I have my YouTube at Painful Profits, my last name, Pain, F-U-L, Painful Profits. So my way to kind of get pro bono work, because of course I'm a financial advisor and we help people. So I compensate the course. My way to give back and give free information is doing these calls, and also my YouTube channel. So we have friends and family that you think might love to get information like this to save them money, to make them money, to help them from a tax credit investment standpoint, definitely give them a link. They can hop on call. And yeah, I'll see you guys in 2 weeks. If you have any questions,